Hello, friends. In this series of videos, I'm going to share the building blocks of my equity portfolio, that is a shares portfolio, right? Stock portfolio. For context, I'm from India. I'm in mid 30s, right? As you can see here, currently I have 10 lakh 17,000 roughly invested, while it shows 11 lakh 9,000 as the total value, which is a gain of almost 91,000 rupees. But please remember this particular snapshot was taken on I think 3rd of November 2023, which is the last Friday, right? And for Monday today, the market is up almost, as you can already see, right? And this portfolio has already gone to 11. Roughly, you can see the gain is now around 24,000. You can add here, which would be 1 lakh 10,000. Although we are not onto this business of day-to-day fluctuations of the market here, but just a broad, you can say ballpark range numbers here, ranging from roughly I've been oscillating between 70,000 to 1,25,000 as total P&L profit and loss. If we add the 14,000 rupees that I have also gathered as dividend right over the last 2 years, then it will roughly be around the ballpark range of that return has been around, you can say 8.5% to 11% roughly, right? Uh, Again, this is the building season, so this is not the final portfolio, as you can see. But these are the broad sectors which are represented here. Uh, IT, so the usual suspects, the materials, which means the chemical stocks, chemical companies primarily, Asian Paints, SRF, Deepak Nitrite, these are the gems here. Healthcare, just one stock here, Capital Point. Consumer staples, which is largely FMCG companies, fast moving consumer goods, largely in the food sector, also in the cosmetics. And then one consumer discretionary in the retail category, which is DMart, Avenue Supermart for the time being. Again, don't go by the absolute nominal numbers here because this is the building phase. So these are not the final weightages that are going to be carried in the portfolio. I intend to 10x this portfolio, so roughly 10x or 15x, right? So I'm seeing in the first tranche roughly 1.5 crores of portfolio in the next, you can say, decade almost, right? So that is to say that and then and only then we'll start seeing a bigger picture emerging. So I had this choice whether I should wait for the next 2 3 years more to let this consolidate and then come up with a video, or just give it a shot. And I thought, let's give it a shot, because in these past 2 years, although I have not seen huge turnover cycles in the market, but I have seen ups and downs. And also in one or two of my stocks, I've even seen a 20% plus, 25% plus drawdowns. So in a day or two, right? Like Gland Pharma, some of you might know, in the month of May and June this year. Then Aarti Industries is another one which witnessed that. So it is not like I have not seen drawdowns, heavy drawdowns. Also, as you can see, the amount is not too big, neither is it too small. Okay, so so I thought, let's just start with the building blocks, and as we move around, uh, I'll show you what has been my learning in the past 2 years, and what are some of the background principles that inform my pillars of investment. Uh, let's begin. Now, this is the first paradigm that I wanted to look into. What sells in the market and what catches our eye in social media primarily is this style of thinking, which is the current things thinking pattern. What is going on? What is going on in the market? Right? As you can see, all these are reputed figures. Those of you who are in the market might also be familiar with the faces here. Again, this is not a criticism of these people. It's just to show you the kind of videos that color and crowd, right, the social media and general market based news cycle. So here is Mr. Basal Maheshwari, a very very famous YouTuber and a very very famous giant investor himself. FII buying kab chalegi, kab aayegi, right? When will FIIs, that is foreign institutional investors, when will they start buying? Meaning that it is directly correlated to the market shooting up. This is one of the queries that he's addressing in the video. This is the current thing. What is going on? Why is HDFC Bank not performing well these days? That is the idea, right? बाजार में होगी बड़ी हलचल. There will be a big noise in the market. Elections and war. No, which war? Israel Hamas war, Ukraine Russia war, elections, Lok Sabha elections coming in 2024. Again, news cycle, current news cycle. Strong stocks in focus. This is the results season. This is Mr. Ishmohit from SOIC, social media community, right, on the YouTube, and I respect him a lot. He is very very knowledgeable, and his report are extremely extremely informative. But again, you see the kind of videos that gather the eyeballs. Then see another very reputed and highly regarded YouTuber here, and also a financial expert here in the stock market, Mr. Shankar Nath. Again, I respect him a lot. Here, the sum of all fears, wars and conflicts, elections, oil prices, inflation, supply chain, forex, climate change, right? And then Mr. Akshay Srivastava, as I think you can see here, is is a mega bubble forming interest rate cycles, right? So what I'm trying to say is this: that what catches our eye is this idea of being in the moment. What is going on today, this hour, this minute, next week, next to next week, this month, this quarter, maybe this year, right? This is more fashionable. It's a fad. It's obviously very exciting. I mean, if we are in this business of or this style of thinking, then we will never run out of content, isn't it? It's highly entertaining. There's no doubt about it. It is highly edgy. If you see the kind of here the snapshots, right, the thumbnails and the headings or the titles, highly edgy and thrilling. The trouble is though that these are short-lived external events, least controllable from the point of view of the agent, which is us here, buying for people, buying and selling people. Extremely single variable idea of analysis. You pick up one particular factor and you start analyzing it right to the bones. It's highly conjectural, it hypothesizes a lot, assumes a lot in the future, and it is predicated upon the idea of an unstable worldview. That this is the world which is constantly changing every moment, and therefore we have to be constantly churning in and out of our own portfolio, buying and selling, adjusting to the interest rate, debt cycles, and constantly maneuvering in our portfolio. Right, companies going in and out of it. This is how most of the news cycle in the stock market is generally predicated. Compare this with the next. So before we go into the alternate style of thinking, here is a peek, right? Now, one mode of thinking is this current style of thinking, the current factor analysis, which I've just shown you in the previous slide. The other aspect of stock market analysis is this propositional thinking, which is more analytical, but it is more Q&A style. For example, are you a dividend investor or are you a growth investor? Are you a value investor or are you again a premium investor who believes in the growth? Now, if you see some of the companies which are in my watch list, right, of 41 companies that I have shortlisted, well, there are companies which are as premium, as costly, one could say, based upon the PE ratio here, as Avenue Supermart, Steamart, 99, almost 100 PE. Linde India, it is a industrial gas company, again 97 PE, 98 PE. Nestle, 97 PE. Procter Gamble, 85. Asian Paint, 69. So Tata Elxsi, 61. It goes on and on, right? And on the other hand, I also have companies which are extremely cheap. You see here, Bajaj Holdings, 15, 16. VST, 15. Sun TV, 14, 15. Power Grid, 12. And MDC, 8. Coal India, 6 or 7. So does that make me a value investor based upon this, that I'm hunting for cheap stocks, or does this make me a premium investor hunting for growth stocks because I'm here also? You see, this is what I'm trying to say, that the kind of questions that we ask ourselves are the kind of answers or responses we are going to get. And that is going to build our worldview or our larger world or the stock portfolio. What I'm trying to say is this, that I ask a very different sets of questions before shortlisting a certain company for my long-term play, right? And as you can see, it could come up because these questions of PE, value, dividend, not dividend, all these become sideline, they become secondary. And therefore, it ends up giving me a good mix of all kinds of companies. See this also. I have companies which give as high a dividend yield as Coal India's almost 8, Oracle Financial Services 5.7, Power Grid again 5.4, VST 4, it goes on now, TCS 3. And as we go to the next one, you will find as less as SRF 0.3%, PI zero point 0.2 or zero point 0.3, you could say Wipro zero point 0.2, and as low as Linde again, just zero point 0.2, Max Healthcare zero point 0.2, you could say zero point 1, zero point 0.2, Tips zero point 0.1, and Avenue Supermarts nothing. Mankind Pharma, although it will be unfair to call out Mankind Pharma here for giving no dividends because it has just been listed on the stock exchange a few months back. Again, so the same idea that whether I go for hunting dividend yields or whether I go for hunting growth. Again, there's a good mix here. So these are not the kind of questions that I'm asking myself while designing my portfolio. What are the questions I'm asking myself? Here's the thing: the current thinking. Some examples: FIIs, DIIs, foreign exchange reserves, currency, wars, cataclysmic events. What are the sectors which are running hot, which are on the rise, on the go? What are the sectors which are running cold, damp, going down? These kinds of news cycles. Wipro has been nuked. Nestle is in big trouble. When will HDFC come back? Right? Promoters are selling big. Are you aware? Right? If you are an investor in Hindustan Unilever, you need to watch this video. These are the kinds of headlines that capture. We are not onto those. I'm not onto those. I'm more onto the first things style of thinking. First things which are almost timeless. They transcend time. They also transcend most of the times cultural background, right? These are things that apply as general principles. These are the ones which I use as pillars to build my own worldview of equity investing, stock investing. Okay? And in these kinds of paradigms of thinking, which is first things, the questions which are asked are very different. So the first question that I would ask is, what is equity investing? And for me, it is as simple as owning a portion of a business, like a shop here, or a farmland here. What is very important to note here is this: the price movement or the market price of these entities, be it the shop or the farm, is of the least concern to me. This is not the first thing or the first principle that informs my decision making of shortlisting and buying or selling even. There has to be something internal to these ventures, be it this shop or be it this farm, that has to satisfy me. I want to act as a part owner of this. It is as simple as saying, if I own a shop and somebody came every day at my door and told me that your shop is quoting at this price or that price, but I know that my shop has failed to generate sufficient cash for my home. Whatever cash is generated by the shop in the profits is to be deployed back in the shop. The shop is so low on the profit margins. I have to always invest back. Now, I will not be sleeping very comfortably at night owning that shop. But yet, these people who come and knock at my door are telling me that my shop is quoting at this or that. You see, if I'm out here to sell that shop and bail out, then it is a very different kind of analysis. But if I'm trying to hold the shop and run the shop, own the shop, then what is happening internally in the shop is of the most consequence to me. So here is one particular illustration of what is a good shop as explained by none other than Mr. Warren Buffett and his ally or fellow friend, Mr. Charlie Munger. Both are, you could almost say, the owners of Berkshire Hathaway, the largest holding company in America. So let's play this. So, for context, the person in the meeting chamber asked Mr. Buffett that, what if we are not as privileged as you, who could have direct access to the board members, insiders of the company or the shop? Neither are we as intellectually astute as someone like, let's say, Mr. Ishmohit or Mr. Shankar Nath of the SOIC or Money Control, whatever, right? That we could pile and analyze and study pages after pages of annual reports and all kinds of research papers to come up to the sound conclusion of whether to buy a particular company or not. What choices do we have? Do we have anything in the records of the company, in the financial statements of the company, through which we can come up to a fair judgment, a practical judgment of this kind, right? That this company would be a good shop to hold for a long run, right? And you see, the opening answer of Mr. Buffett is explaining this first thing's internal style of thinking about the venture. That for him, the investment is an internal point of view. It is, I'm buying a particular asset like a shop or a farmland to own it so that it can generate cash for me, for the business in future. I'm not buying it to sell it in the future. I'm buying it to earn cash for me and for the business to grow in the future. That is as simple as that. But what is very interesting is that Mr. Buffett himself does not explain or point out something in the financial statements that is going to highlight the goodness or the quality of a business, a shop. That is left for Mr. Charlie Munger to answer. Why Mr. Buffett does it? One plausible reason is that he's extremely ethical in this scenario and he can sense his obligation for the forum, this kind of public forum, right? And he doesn't want to say anything mathematical or too specific, which could be taken as a soundbite, right, and quoted out of context. But as we all know, Mr. Munger is not that type, so he is going to be extremely forthright with it, right? And we are going to see that. See, this is the first things rule that I have taken to the heart from Mr. Munger, particularly here. A good business, as simple as that, is pointed down to the fact that a good business is one, a good shop, a good farmland is one that drowns in cash, that produces so much cash that it doesn't even know what to do with it. To give it back to the shareholders, to the owners, part equity owners, to retain it back in the business, or to make acquisitions or capital expenditure, capital expansion, capex, to grow the business. That is how rich by cash our good business is. A not so good business, which would still might be growing, like Siemens India, if you look at the balance sheet and the growth of Siemens India, which is a multinational corporation subsidiary being listed in India. A good business grows, but it grows through machinery and debt over time. It, whatever cash that kind of an average business that generates, it has to deploy it back. Now, there are many controversial remarks I might end up making here, but for now, I'll just wait for with this one. But there's some darling companies, there are some sweetheart companies which might be up, right, for this kind of a judgment, right, as we go along. Now, so a good equity business is that which drowns in cash, not machinery and debt. Meaning negligible. Whatever I say here is broadly in the ballpark range. I'm making some broad assessments here. I'm not going on to a particular decimal number detail, right? A great company will have debt, but it will be negligible, right, to the equity portion of it. And it does it over time, time after time after time, which is on its compounding. Right? It exponentially grows through this cash. Why cash? Why this cash is the most important aspect of analyzing a business? Because there are three uses of cash. One, to bring it back home, which is to give it back to the owners, which are us shareholders, or to retain it back in the business, to reserve it, right, for future uses. What could be the future use? Again, either to bring back home, give it back to the shareholders, or to run and maintain the business, grow the business, mergers and acquisitions, capital expenditure, whatever that might be, right? So either to give it directly back to the shareholders, or to deploy it back in the business, or to hold it, to retain it. This retaining is done. You'll find this in the balance sheet of the company as reserves and surpluses and retained earnings, right? This bring back home is the dividend or the bonus shares or the share buybacks that the company does. We'll see that. And this is the capex, capital expenditure and general expenditure, mergers and acquisitions, and those kinds of things, right? Now, again, what I assume that people who are watching this video are fairly aware with the stock market and the basic nuances of PE, PB ratio, debt to equity, payout ratio, dividend yield, because there are much better videos than this for us to get a tutorial on those, right? Nonetheless, if this particular video gathers momentum, then we are certainly going to discuss, right, those features. But for now, I assume that most of us know this. So when we use the concepts here, we are only going to use it in the most practical sense, where it makes sense for us as the equity owners, right? You see, a great business balances all these three uses of cash. It will use the cash which it generates. Remember, it is drowning in cash, so it will have excess cash, and it is going to use it in a very diligent manner, in a very prudent manner. Some examples I know, which I can see, are TCS, ITC, Nestle, Unilever, Abbott India, which is the subsidiary of Abbott Labs, Asian Paints, and so on. A not so great but still a good business would at least be able to prioritize two of these, right? Some examples that I can see are Sun TV, VST, which is the cigarette making tobacco company in South India, Colgate Palmolive, Procter and Gamble, Bajaj Holdings, and so on, right? These are cash rich companies. They have so much, they are drowning in cash. All these examples that I've taken here, they have one common feature: they are drowning in cash. They have filthy amount of cash, right? In terms of profits and free cash flow. Now, as we said, no, three uses of cash here: to bring home, Now, there are two direct internal ways in which the company returns cash to its equity owners. Only two, friends. One is by dividend, direct credit in the bank account of the equity holder, or share buybacks, where shares are bought back by the company and they are retired. So, when the share count becomes less in the company, our stake in the company becomes more, and in the next dividend cycle, we tend to earn more income, right? Or share bonuses, issuing additional shares, right? It increases again our stake internally, right, within the company. The other one, the third way in which company may return the cash is a more indirect external way, which I told you earlier, the market quoting of the price of the company. That there has been a capital appreciation in the price of the stock. Now, remember, if we are the buy and hold kind of investors, we want to hold it for the cash that we will receive in future, then this capital appreciation is the least important phenomenon. For that is not to say that the companies that we are going to hold, right, as per these principles, are going to destroy our capital. Not at all. But this is not the first thing. Remember, first things, right? The first thing is to look for the cash. The first thing is not to look for capital appreciation, to look for the cash rich companies, not for capital appreciation companies, right? Now, again, this is almost a false dichotomy, because most of the capital cash rich companies are also going to give us healthy capital appreciation, right? But this I'm least interested in, because I'm not going to sell unless my thesis changes on any one of those pillars which we are going to discuss subsequently. Okay. Obviously, capital appreciation, external quoting of the price, is great if it is due to the increased revenue and profits, which means that if we go back here, right, that the company has used the cash in a very diligent manner to run, maintain, and grow the business. And that is how its profits have grown here, and that is how its value price has grown, right? Because this growth in revenue and profit is internal to us as equity owner, not this capital appreciation. Line going up on the chart matters least to me, right, as an equity owner. The other very important aspect, right, about equity holding, please remember that we as equity owners are last in the queue of capital structure. What do we mean by this? It is both a bane as well as a boon. It is both a curse as well as a benefit, right? A blessing. How? The company is, as a legal and economic entity, is made up of certain stakeholders. We as the equity owners are last of those stakeholders. The first are the employees, the business itself, its moving components which require investment and spending, administrative costs, selling cost, right? Capital expenditure cost, so on and so forth, maintenance costs. Then there are lenders, the people who have lended out money, debt, right, of the company. And then there is government for the tax. After and only after this, we come as equity owner here. It is one, two, three, four. We are on the fifth. What does this mean? In the bad times, if the company is going through a down cycle, losses or decreasing revenue and profits, we will be most hurt. Why? Because the employees often than not are compensated. The business will look out for itself. Lenders have legal lien upon the company, legal liability upon the company, so they have to be paid. And government taxes, right? They have to be paid. It is us as equity owners who are going to be left. Right? But on the other side, if the company is in the upcycle, meaning that the company is doing great revenue and business and general enterprise, then just think about it. All these are almost fixed costs. Fixed, almost. Whatever remains is ours. So there's no real cap on what we earn. Earn as in earn through dividends and earn through share buybacks and share bonus shares, right? There's no limits to that. So once we start holding good companies for a long period of time, we have almost no limits, no ceilings of how much we are going to gain. This is the boon. The bane, the curse is that if the company goes down, these people will be compensated, not us. We are going to lose all our equity. But if this company survives over time, and that is where we are going to make a bet, an informed long-term bet, that these will be paid out and they will be, escorted out of the company, so to say. We are the ones who are going to remain and own everything that remains. So this is how we have to start seeing that we being the last in the queue of the capital structure is both a blessing as well as it is a blessing in disguise. Right? We are the last in the queue, but we'll get everything that is left once the queue has been settled. Therefore, because this is the larger capital structure of the company, These are the stakeholders. Therefore, a great business rationalizes costs, all these costs: salaries, manufacturing costs, which is business itself, depreciation cost in the assets, physical assets of the business, maintenance costs, which we say, right, in business itself, administrative costs, debt interest, lower the debt, lower the lenders, lower the debt interest payment, and taxes. Now, as you can see, out of all these, right, the company really has not much leeway on the taxes. That is almost like fixed portion. But on all the others, a good company will rationalize, will be able to make margins, will be able to make gaps in the income and the expenditure, isn't it? And the lower each one of these components, the greater the margins are, the greater the difference between the revenue and the actual profit is, income and the actual profit, realized profit is, right? Therefore, the single most important factor for me in assessing a good business, which is directly related to it drowning in cash, has to be the profit margins. This is one of the least discussed aspects in most of the Indian social media circles. If we go back here, most of these friends, they rarely talk about here. They rarely talk about profit margins, and even if they talk about it, they just mention it in the passing, or often in tandem with ROC and so on and so forth. Right? Not me. For me, profit margins are the most important aspect, along with the cash cycle. Cash cycle basically means how many number of days a company takes to convert its inventory and its general sale into actual realized cash profit. Right? The lower these number of days, the greater the efficiency of the business. Once you match both of these together, you get a great cash drowning machine, a cash drowning shop, or an agricultural farm. This is the Buffett principle. Therefore, high debts, you see here, lenders, debt interest, it will hurt margins. Depreciation, high physical assets requiring maintenance will hurt margins. Capital intensive, right? High capital expenditures are going to hurt margins. Low debt, asset light companies are the ones which are generally extremely cash rich, right? Barring a few exceptions, which we'll see. Therefore, just to expand on that idea of what is a great business, as per the first things principle, as per the long term principle, as per the internal point of view principle of the equity holder, it's the one which drowns in cash. How does it drown in cash? Because it has very low debts, it has low capital expenditure requirements, it has great cash conversion cycle, smallest perhaps, maybe in the negative, right? It has high free cash flows, and it has high ROC, but most importantly, it has a very high profit margin. It's a very high profit margin. This is how we start seeing the some of the nature of the businesses.